two of what I counted to be five, you guys. 5 times he said we're well positioned to wait. Let's bring in our floor show, people. Joining me now, JP Morgan Asset Management Global Market Strategist Meera Pandit and Slate Stone Wealth Chief Market Strategist Kenny Polcari. Meera, let's get to you first. This is a significant meeting, and the markets are reflecting that. What do you think the markets heard that have them jumping so exponentially?
The markets heard a Fed free from fear. All fall, we have been debating, are we more worried about hotter inflation or weaker jobs? And we heard a relatively sanguine tone from Chair Powell. I'd also say if you look at some of the details of what the Fed is seeing in the year ahead, stronger growth, relatively stable unemployment relative to where we are today, inflation that is going to continue to come down after moving a little bit higher due to tariffs. But he did reinforce that while in previous press conferences, we don't know whether tariffs might be a little bit sticky or not, he seemed to lean more into the narrative that tariffs will be a one-time increase, and they're not as worried about potential stickiness there. So I do think that that positive tone overall that was struck by Chair Powell, hopefully reflecting the committee's views there, was something that gave the markets a little bit of holiday cheer.
Yeah. Kenny, I don't know if you just heard Professor Siegel, but he said it wasn't a hawkish cut. I felt like it was a very calm, wise owl with a tiny bit of dove thrown in there, a few dove feathers. What did you hear?
I actually thought that it was. I did think it was a hawkish cut. It wasn't a far right hawkish cut. But I think he made it very clear that we're at this rate now. That they're not going to just start cutting in January and then again in March. He made it very clear, to Myra's point, that the labor market is not falling out of bed. Inflation, while elevated, appears to be under control, and he still says it's going to 2%. He didn't at all give the sense that he's uncomfortable or nervous or anything about what he said. So I think he actually gave the market the sense that it is under control. He feels very good about it. And now the rest of us can kind of step back and then focus on all the other stuff. We don't have to keep talking about what's the Fed going to do in 6 weeks.
Well, then what does the investor do, Meera, as we look at what's going on with the markets at the moment? Boy, anybody who's sold ahead of this is out of the money. Longer-term investors, how do they view this? How should they view this?
The title of our outlook this year is AI Lift and Economic Drift. So we may continue to see that the economy drifts along into next year, but really I think the markets are able to then refocus on some of these longer-term secular opportunities around tech.
Maybe that drift is the reason that the so-called dot plot, which is where every Fed member points to where they think the Fed funds rate, the benchmark interest rate, should be. And what I thought was interesting here's the dot plot. Now, it looks like a bunch of, I don't know, unidentified flying objects here. But we had, I believe, 7 wanted no change next year. They want pauses. 11 wanted one cut. 1 wants the rates to be lower. They want 150 basis points lower next year. That we're going to assume is Stephen Myron. Kenny, what does this tell you?
I think Stevie Myron needs his head examined. I can't see that we're going down 150 basis points from here. That's ridiculous. Like Jay Powell said, we are basically at the mostly neutral rate that most of the members agree with. So while I think we might get maybe 1 cut next year, if even, I don't think we're going at all way out down the scale. Look, I think Goldman Sachs and Bank of America have 2 cuts priced in. JP Morgan, I think, is about 3. And then there are others that still have 4 basis cuts. I think that's ridiculous. But one way or the other, I think right where we are is probably good. Look, remember, I was in the camp. I didn't think they should have cut even today, but they did. So that's it. Now I think we're good. We have to sit.
Okay, let's talk about where investors should be putting their money. And Meera, you don't fight the Fed, go with U.S. equities, large caps, I would imagine. But you also like the small caps. Russell is hitting a record right now.
I would say that small caps could have a nice tactical bounce here. You're seeing that right now. When you see lower rates, when you see stronger growth, that tends to be a good environment for small caps. And that may bear out in the first half of next year. We're expecting higher than average tax refunds for the average taxpayer by $750. We know that a penny earned is a penny spent when it comes to that U.S. consumer. So we may have this nice boost to growth. We may also have a little bit of a boost to inflation from that. And that lower rate rate environment can also help small caps. You head into the back half of the year, the economy maybe starts to cool down, reassert that K-shape overall divide between upper and lower income consumers, and perhaps that's an environment where small caps start to hit a bit of a wall. So I would still lean into, in the longer term, some of these larger cap, high quality names, because that small cap rally might be a little bit more tactical, a little bit more short-lived. And what we saw from April through October was this huge low quality rally that reversed really sharply in the first 3 weeks of November. So it's a good reminder that a lot can be thrown our way next year, and we want to make sure that we're positioned not just to partake in the rally, but also to partake in protection if things don't shake out as positively as they are right now.
Okay, guys, I am looking, and Kenny, I want to know your thoughts about where to invest and maybe sectors work here. I'm looking at the home builders at the moment. They are going crazy here.
Right.
We've got, let's see,
Right.
BLD, top build is up 4%. You've got DH Horton up 3.8%. Lennar up 2%. I mean, they're just going nuts here. KB Homes up 4.25%.
Right, it's going nuts on the idea that mortgage rates are going to be low. And now, look, mortgage rates right now are still 6.2% about. So let's see what happens with mortgage rates. I'd see, in fact, if they do come down. But I'm a little bit, for the early next year, I'm a little bit more cautious just because of what I think the chaos that this midterm election can have, at least early part of the year, when there's a lot of confusion around who the candidates are. So I'm going to play it more. I'm going to play it a little bit safer. Financials I like, consumer staples, which have been the huge underperformer this year, I think is a place that people can find some stability and some protection if we get that volatility that I actually think we're going to get in the first half of the year until it becomes clearer who the candidates are, where they stand, are they left, are they right, are they kind of in the center, and then I think the market will then settle down. Small caps I like. And I do agree with her as we move through the year, maybe you have to be a little bit more strategic about when you get out.
Well, HSBC, U.S. Bancorp, M&T Bank, they're all up anywhere from 3 to 7%. All the financials, at least the bigger ones, look pretty strong.